Greetings, grade 12 learners. My name is Mr. Simbi, and welcome to today's accounting lesson. In today's class, I'm going to be doing analysis and interpretation of financial statements. Here are my lesson objectives. I intend on calculating certain financial indicators. I will also analyze and interpret on profitability, liquidity, solvency, return, and risk financial indicators. Here are some keywords and language. These are the critical common errors that we need to focus on. In grade 10, we have calculated certain financial indicators for a sole trader and partnership. In grade 12, we'll also calculate more financial indicators, but now they relate to a company. As we did in grade 11, we're able to analyze and interpret the financial indicators. We will do the same in grade 12 to analyze and interpret financial indicators of a company. Dear learners, let us go for an ad break, and I'm going to see you shortly. Welcome back, dear learners, from the ad break. I will now begin to look at profitability financial indicators. Here are some of the content skills problem. In grade 10, we calculated profitability financial indicators. We were able to analyze and interpret them. These indicators provide an insight into how effectively a company is managing its resources to produce profit. These are the profitability financial indicators. You have your gross profit on sales. You have your gross profit on cost of sales. You have your operating profit on sales, and your operating expenses on sales, and your net profit on sales. You will see that these financial indicators are easy to calculate, and you have been doing these from grade 10 and grade 11. I'm going to calculate in this activity the markup percentage achieved. The markup percentage achieved. When we calculate the markup percentage achieved, we will need to know the formula. That is very, very important. You need to know your formula. And to calculate the markup percentage achieved, we're going to say it is my gross profit over my cost of sales. I multiply that by 100 over 1. So, to get my gross profit, it is given here. I have my 5,400,000. That is my gross profit. And I'll divide that by my cost of sales. But I can see here, my cost of sales is not given. So I have to calculate it. And to calculate my cost of sales, I'm taking my 12,600,000, which is my sales. I'll say 12,600,000. Then I subtract my gross profit, which is 5,400,000. And then that will give me my cost of sales, which is 7,200,000. So I'll bring that here now, 7,200,000. And then I multiply all this by 100 over 1. That will give me my answer, which is 75%. That becomes my markup percentage. Once I've calculated this, I should be able to analyze and comment on this financial indicator. So here I can see in 2021, it was 80%. In 2022, it is now 75%. So let us comment. But before we comment, we should be able to analyze. Let's see. We can see here that the markup percentage has decreased. So I'll come here, then I'll say the markup percentage has decreased. I need to see this word, that whether it has decreased, increased, or remained constant. So the first one is the name of the financial indicator. I need to see the name. I also need to see the trend. Did it increase or decrease? In this case, it decreased. That is the second thing. So the markup percentage has decreased from, then I'll say, 80% in 2021 to 75% in 2022. The comment now. The company's profits have decreased. The company's profits have decreased. All right. So I've commented on this one. I managed to speak of the name, the markup percentage, as well as the trend, increase, decrease, and the figures. That is from 80% to 75%. And then I also commented that the company's profits have decreased. Very important that we do so. Let's look at the second one. Let's look at the second financial indicator. We're now going to look at liquidity. Liquidity. Here is the content and skills problem. Liquidity or working capital financial indicators are used to assess a company's ability to meet its short-term obligations using its most liquid assets. So basically, we're looking at the ability of a company to pay its short-term debts using its current assets. Okay. And these are the financial indicators. You have your current ratio, your acid test ratio, stock turnover rate, stock holding period, the average debtors collection period, as well as the average creditors payment period. In this activity, we are going to calculate the acid test ratio. Formula is of great importance. I know at the back of the question paper you're given the formula sheet, but do not over-rely on that formula sheet. You need to know the formula by head. I always tell my kids, it has to be in your fingertips. You have to know it so that when you look at the formula sheet, you are just looking, but you know it already. So do not over-rely on the formula sheet. The formula for the acid test ratio is our current assets minus inventory. Our current assets less inventory as to our current liabilities. So we are looking at the ability of a business paying off its current liabilities without relying on inventory. And in this question, we have total current assets, which is 1,323,000. 1,323,000. We also have inventory, which we're going to subtract now, which is 514,500. Our inventory is 514,500. All that as to our current liabilities, which is 735,000. So let's solve this part first, where we say our current assets minus inventory. So once we do that, we're going to end up with 808,500 as to 735,000. Now I'm going to show you how to get the answer here, because your answer has to be as to 1. That means you divide what is on your current liabilities by the current liabilities amount, which is 735,000. So you get that 1. And you come here, you say 808,500 divided by 735,000. 735,000. Let's do that together. So you now say 8 or 8,500. Then we divide that by 735,000. That will give me 1.1. So my answer here becomes 1.1. So it becomes 1.1 as to 1. That becomes the answer now. 1.1 as to 1. Now that we've calculated this, we must be able to analyze and comment. So the asset test ratio in 2021 was 0.4 as to 1. Now it is 1.1 as to 1. I'll come here, then I'll say the acid test ratio has increased, or I can say improved, increased or improved from 0.4 as to 1 to 1.1 as to 1. Comment now. The business is able to pay its short-term debts. That is how I would comment. Dear learners, let's go for an ad break, and I'll see you shortly. Welcome back from the ad break. We are now going to look at the solvency financial indicator. Here are some content and skills problem. The solvency ratio was done in grade 10. We did in grade 11 as well as in grade 12. We're going to do it as well. It measures the company's ability to meet its long-term debt or long-term obligations. The formula is total assets as to total liabilities, and it must be as to 1. Your answer has to be as to 1. Let us do the calculation together here now. So remember, formula is very, very important. So you have to get your total assets here. You have to get your total assets. And then it has to be as to your total liabilities. To get my total assets, I'm going to take my fixed assets, which is 8,746,500. And then I'm going to add my total current assets, which is 1,323,000. Once I add these ones, they should give me 10,068,500. 10,068,500. And then I'll add my total liabilities, where I have my total current liabilities, which is 735,000. I add my non-current liabilities, which is 5,095,400. So their total gives me 5,830,400. Now that I have my total assets as well as my total liabilities, I can then say, I'm going to do it on this side now. I'll then say my 10,068,500 as to the 5,830,400. Remember, the answer has to be as to 1. So I'll divide everything by 5,830,400. Hence, I get the 1. Then I'm going to now divide my 10 million and 68,500. I'll divide that by my 5,830,400. That will give me 1.72. So I'll come here. Then my answer is going to be 1.7 S to 1. 1.7 S to 1. Let's go and comment on these figures. So here it is 1.7 S to 1. In 2021, it was 0.9 S to 1. Now it is 1.7 S to 1. So I'll now say the solvency ratio has increased or improved from 0.9 S to 1 to 1.7 S to 1. The business is solvent. That is how I would comment. Let me move on to the next financial indicator. The next group that I'm going to talk about is the return ratios. Here is the content and skills problems. Return ratios are used to assess the profitability and efficiency of a business in generating returns for its shareholders. Here are the financial indicators that we look at on the return. We'll calculate our ROCE, that is the return on shareholders' equity. Return on capital employed, our ROCE. EPS, earnings per share. DPS, dividends per share. NAV, net asset value per share. And the dividend payout rate. In this question, we are required to calculate the NAV, net asset value per share. Formula is very important. For your net asset value, you are going to say my shareholders' equity divided by the number of shares in issue. Number of shares in issue. We multiply by 100 cents. Remember, my answer here must be in cents. So, I will take my shareholders' equity, which is my 8,840,700. I divide that by the number of shares. There was 1 million shares on 1 March. That is the beginning of the financial year. 200,000 shares were issued, so we issued a further 200,000 shares. 50,000 shares were repurchased on 1 December, so we'll come here then we say minus 50,000. That means the shares in issue at the end of the year is 1,150,000. So I'll come here, I'll divide this by 1,150,000. I multiply this by 100 over 1. If you punch that on your calculator, you should get 768.8 cents. 768.8 cents. Let us analyze and comment. If you come here, you see in 2021, it was 650 cents. In 2022, it's 768 cents. I would then comment and say, the net asset value per share has increased from 650 cents to 768 cents. All right. Now, the net asset value, it simply gives us the value that has been assigned to each share. So we can then comment and say the value of shares has increased. The value of our shares has increased. And then I'm going to go to the last group now, which is risk and gearing. Here is the content and skills problems. Our gearing ratios assess a company's financial leverage, indicating the proportion of a company's capital that comes from debt compared to equity. These ratios help in understanding the level of risk associated with a company's capital structure. The debt-equity ratio, it is your non-current liabilities as to shareholders' equity. It must be expressed as to 1 as well. So I'm going to come here and I'm going to calculate my debt equity. So I know I have to say non-current liabilities as to my shareholders' equity. So my non-current liabilities, it is my loan, 1,817,600, as to my equity, 8,840,700. Then I'll divide everything by 8,840,700, such that here I get as to 1 already. So I divide this by 8,840,700, and then it becomes 0.2 as to 1. Let me comment on these calculations. In 2021, it was 0.4 as to 1. In 2022, it's 0.2 as to 1. So I can say the debt equity ratio has decreased, but in this case, it is an improvement. It has improved from 0.4 as to 1 to 0.2 as to 1. Then I can comment and say the risk is low. In this case, there is low risk. So with me here, I have a question, an extract from the NSE June for the year 2022. And it reads, refer to information A, identify and explain which company has been more efficient in controlling its operating activities. Got 2 financial indicators. So here we have 2 companies. We have Frede Limited and Nigel Limited. So we want a company which has been more efficient in controlling its operating activities. So we're going to look at financial indicators that have to do with operating and efficiency. All right. So the first one we're going to look at is operating expenses on sales. Operating expenses on sales. If you look at your operating expenses on sales, you can see that Frede, all right, has 23.9%, all right, but Nigel has 23%. Okay, so the financial indicator for Nigel is lower than that of Frede because Frede has 23.9, yet Nigel has 23%. So there's a difference of 0.9 points. All right, let's go on to the next one. Operating profit on sales. Now, if you look at the operating profit on sales, Nigel has 19.9%, which is better than that of Friday, which is 13.6. Okay, so Niger has a higher operating profit on sales of 19.9%. That therefore is better than that of Friday, which is 13.6. And there's a difference of 6.3 percentage points. And then the next one. If you look at Niger, their net profit on sales is 9.2%. Net profit on sales, it's 9.2%. That is better than that of Freddie, which is 7%. And there is a difference of 2.2 percentage points. A difference of 2.2 percentage points. So in this case, we've identified that Niger has been more efficient in controlling its operating activities. Next question. Identify and explain which company has better liquidity financial indicators, core two financial indicators. Okay, so we want a company that has better liquidity, and we're going to quote two financial indicators. Explain one concern you have about the liquidity of the other company. Okay, so let's start. Number one, if you look at the current ratio, Freddie's current ratio is 1.8:1, and Nigel's current ratio is 1.2:1. So you will see that Freddie has a current ratio of 1.8:1, which is higher than that of Nigel. All right, and the difference is 0.6:1. So in this case, you can see that Freddie has a higher current ratio than Nigel. The next one, if you look at the acid test ratio, Freddie's acid test ratio of 0.7:1 is higher than that of Nigel, which is 0.5:1. So here, these are the two indicators that we can look at. The next part of the question is now saying, explain one concern you have about the liquidity of the other company. So the other company would therefore be what? Nigel. Now, let's look at the concerns that we have about Nigel. If you look at Nigel's acid test ratio, which is 0.5:1, and their current ratio, which is 1.2:1, it shows us that in this company, there is poor management of working capital. In other words, it will be difficult to meet their short-term debts. And you can see their stock turnover rate of 23 times. It may indicate that stock is too low to meet customer demand. So they are not looking well for their customers as they're keeping low stock levels. I'm going to go to the next question then, which is now from the NSE June 2022. All right? And it is relating to dividends. It says, comment on the difference between dividend payout rate policies implemented by the directors of the two companies and explain one possible reason for each of their decisions in their respective companies' quote figures or indicators. If you look at Freddie, they have earnings of 2.54, which in other words is 254 cents. They've earned 254 cents, but they've only given 190 cents as dividends. Therefore, their dividend payout rate is 74.8%. It means they've given 74.8% of their earnings as dividends. But if you look at Nigel, they have earned 410 cents. In 2022, they have given 440 cents as dividends. That means they've given more dividends than what they've earned in 2022. Hence, you see they've given 107% of their earnings as dividends. Now, it says, comment on the difference between the dividend payout policies implemented by the directors of the two companies and explain one possible reason for each of their decisions. Okay, so we're going to start with Freddie. The dividend payout rate is 74.8%, which is this one here. I've explained it. The company gives 74.8% of their EPS to shareholders as dividends. That means the company is only retaining 25.2% as a reserve for the company. They paid 190 cents as dividends of the 254 cents of earnings that they had made. 75% was retained. That is 64 cents for future growth. Okay, so we have commented on Freddie. And then, why would they have done that? These are the possible reasons for their decision. Number one, trying to keep shareholders satisfied with their investment. Number two, to allow for expansion, that is growth, decided to hold funds in reserve for contingencies. If a company is to grow, they need to retain. Then they can use what they've retained for future expansion. The directors also did this to strike a balance between appeasing the shareholders and ensuring continuity, that is, sustainability. Let's now come to Nigel Limited. If you look at Nigel Limited, their dividend payout rate is 107.4%. That simply means they've used the retained income to pay dividends. They've used 100% of their earnings and took what was retained in the previous years. Hence, they gave 440 cents of their earnings, which was 410 cents as dividends. So that means they had to borrow 30 cents from the previous year's retained income in order for them to pay dividends. Dividends of 440 cents exceed the EPS of 410. There is that negative effect of 30 cents. Why would they have done this? Here are the possible reasons. Number one, trying to keep shareholders satisfied with their investment. Secondly, directors want to create a positive image of the company or its directors, possibly for re-election. Lastly, this is an aggressive decision by the directors to convince shareholders about their strategies. Dear learners, let us go for an ad break, and I'll see you shortly. Welcome back, dear learners, from the ad break. I have here with me a question from the NSC June 2022, and it reads, gearing, risk, financing and investing activities. Refer to information A, B, and C. Here are the questions. Explain the specific decisions taken by the directors of each company that have affected gearing and risk, quote, rand amounts. Now, whenever you see the cash flow statement, we must be able to look at decisions that directors have taken and how they've affected the company. So we're going to look at some of these decisions, and we're going to begin with Freddie. If you come to Freddie and you look at their extract of the cash flow statement, you'd want to see what decisions did these directors take. So number one, you can see here, they issued new shares. So they issued new shares and they received 9.9 million. That is a major decision that the directors have taken, which affects the company. The second one, when you come here, you can see there's a change in loan. That means they have repaid the loan. So I would say the second aspect is the repayment of the loan, 2.5 million. This are the two major decisions that we can see which the directors have taken that have an impact on the company. We have done Freddie Limited. Let us see if we can do Nigel. When you come to Nigel, you will see that they have repurchased shares here and they have spent 7,540,000. So that would be the first aspect. Shares were repurchased and the company used 7,540,000. And the second aspect you can see as well is the change in loan. That's a positive 3 million. Unlike Frede, where it was a negative 2.5 million, that showed the repayment of loan. In Nigel, it's a positive. That means an increase in loan. We have received 3 million. We have increased our loan. These are the two major decisions that we can see from the cash flow extract of Nigel Limited. The next question then says, comment on the gearing and risk of Nigel Limited, quote to financial indicators. Once the question comes and it wants you to comment on gearing and risk, there are two financial indicators that must come to your mind, okay? So the first one, the financial indicator that must come to your mind is the debt equity, your debt equity. Okay, so if we come and look at our debt equity, we are looking at Nigel Limited. If we look at our debt equity, it was 0.6 as to 1. Now it's 1.3 as to 1. So let's go. So the first one is the debt equity ratio of 1.3 as to 1, which you see over here. That is high. This is high financial risk. It shows an over-reliance on borrowed capital. This is very risky as it is bordering on insolvency. Let us therefore come to the next financial indicator. So far we spoke about the debt equity. The next one, once we talk about gearing and risk, we will now look at interest on loans versus our ROTE, the return on total capital employed. We want to see if we are positive or negatively geared. In this case, let us look. You will see that in our company, the return is 16.2%. This is higher than the interest rate on loans of 12%. So in this case, we are positively geared because we have a return on total capital employed of 16.2%. 16.2%. Once your ROTE is higher than the interest rate on loans, it means you are positively geared. You're making effective use of your borrowed funds. So I would say the ROTE of 16.2% indicates positive gearing. Better than interest rate of 12%. In other words, the ROTE is higher than the interest rate of 12%. Nigel Limited is making effective use of capital employed to generate profits. So you see, when you look at Nigel, it is positively geared. I'm going to comment on Frede so then you can have a clear picture. With Frede, their interest rate on loans is 12%, but their return is 10.5%. So it simply means Frede Limited now is negatively geared. There is negative gearing on Frede Limited. Why? Because their percentage return on total capital employed is 10.5%, which is lower than the interest rate on loans. It means Frede is not making effective use of their borrowed funds. In this case, it is wiser to repay the loan that is in Frede. But in Nigel, since we're positively geared, we are making effective use of our loans, that is a good situation. All right, so we have commented here on risk and gearing. On risk, we spoke about the debt equity. And on gearing, we would say interest rate on loans versus the return on total capital employed. We are looking at two things. Either we are positively geared or we are negatively geared. Once we are positively geared, we are making effective use of our loans. But if we are negatively geared, we are not making effective use of our loans, it would be in our best interest to repay the loan quicker. Dear learners, let us go for an ad break, and I'll see you shortly. Welcome back, dear learners, from the ad break. Here are some keywords and language recap. The statement of financial position and the statement of comprehensive income. These are the critical common errors, and we're making a recap on these errors. For further practice, please go and get questions from the November 2020, question 4, November 2019, question 5, May, June 2019, question 5, and November 2018, question 4. Thank you so much for joining me in today's class. Until next time, goodbye.